Very good. Thank you all for joining us today for our third quarter 2024 review and market outlook webcast. My name is Michael Musio. I'm the president of FBB Capital Partners, and I'm joined, as always, today by my colleague Michael Bailey, who's our director of research and chair of the FBB Investment Committee. And working behind the scenes today with the technology is our teammate Ronan Bogley. Today we'll review the third quarter of 2024 and look ahead to what may lay ahead for investors for the final quarter of 2024. We'll then have an opportunity for some Q&A that will address previously submitted questions and allow for live questions on the fly. A couple of housekeeping items. First, you'll note that Mike and I are both home. That is a rare event, particularly on days when we are doing the quarterly webcast. The FBB home office in Bethesda is currently about halfway through a 8 week construction or renovation. So we're all working remotely right now, but looking forward to being back in Bethesda here in a few weeks. So apologies for the remote work look here. It's not our norm, I know. Additionally, you'll note while you can see and hear us, as this is a Zoom webcast, attendees will remain in anonymous view only mode. However, we expect and are eager to answer your questions as they come up. Please look at the bottom of your Zoom screen and roll your cursor by, and you'll see a Q&A box there with a question mark. At any time during the webcast, feel free to click on that, type in a question. If we can get to it on the fly, we'll do that. If not, we'll get to it at the end. I will introduce each question as it comes in, referring to the first name of the questioner, and then Mike or I will answer the question. I will try to combine questions that are similar, just that we're able to get as many answered as we can in the time that we have. Finally, we're recording the call today, which will be posted for replay on our website probably before close of business tomorrow. That recording is now begun. And as we begin today's discussion, let me remind you of the fact that today's commentary is based on the facts as we see them today, which of course are ever changing. Please note that any reproduction or transcription of statements made during this call without our prior approval is prohibited. Should you know someone who you think would like to listen in, you can direct them to our website. And please note that all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from expectations and assumptions that we discussed today. Finally, please review our complete compliance statement and disclaimer at the end of the webcast. Whew. With all of that behind us, I will turn it over to Mike Bailey to kick us off. So Mike, please.
Great. Thanks a lot, Mike. So today we're going to focus on some big changes at the Federal Reserve over the past 2 years and look at how these changes are impacting the bond market and stocks, both within the tech sector and beyond. We'll then turn to our positioning and wrap up with your questions. Next slide, please. All right, so before we get into markets and the economy, I thought I would step back a little bit and give an example from another field to give us some perspective. In sailing or other activities where you need to have a focus and direction, even a small change can put you way off target. If your direction while sailing is slightly off, you need to make a big course correction and make it early before you get even further away from your destination. In a similar way, the Fed in 2022 saw inflation as transitory. But Jay Powell quickly realized that this was a big mistake, and he spent the better part of the next 2 years raising interest rates and keeping them high as a way of slowing the economy and extinguishing this rampant inflation. So Powell and the Fed, it appears that they've successfully reached their destination after a big change 2 years ago. However, we could be at the beginning of another journey for the Fed, and investors are eager to know what's next. So with that, let's turn to slide 5. Keeping with our sailing analogy, the Fed has just avoided one dangerous problem with inflation, but Jay Powell needs to avoid an extreme course correction away from inflation that could push the economy into another problem, unemployment. For example, if the Fed keeps interest rates high to stop inflation, that could unintentionally slow the economy so much that we could end up with another problem as companies lay off workers. Fortunately, it appears that the Fed is sailing through this narrow channel and avoiding the red flags, both of inflation and unemployment, especially as the Fed has now started lowering interest rates as a way to help out workers and consumers. We'll get some real-time feedback on this Fed action tomorrow with a monthly jobs number. However, as we'll see on the next slide, there are some cracks in the economy worth watching. Next, please. So as we just discussed the Fed's role in stabilizing the economy, we are at the same time seeing some lingering effects of high inflation and rising interest rates that are pressuring some groups, in particular lower income workers. Dollar stores, which often serve this low income group, are seeing pressure with customers who are struggling to buy goods that can cost 20% or more from a couple of years ago. These same consumers are also seeing some of their employers cut their hours in terms of hourly workers, and that can eat into their income. As one example, the CEO of Dollar General said in a conference call last month that their core customer is telling us loud and clear that they're feeling less confident about what the future holds. So even though this type of commentary can sound a bit like gloom and doom, it is a reminder that inflation and the Fed's response do have consequences. However, to kind of put this in perspective, we are seeing other parts of the economy continuing to grow. In fact, our research team at FBB did a call yesterday with a national provider of uniforms, doormats, and bathroom supplies. They serve about 1 million small, medium, and large businesses. This particular company has yet to see any signs of a slowdown in demand. So again, seeing some mixed signals out there. So as investors try to figure out what's next for the economy, let's take a look at what the Fed is doing and how that could impact workers and consumers. Next slide, please. As we mentioned, the Fed is now shifting into a loosening policy, beginning with a relatively large half-point cut in interest rates last month, likely followed by a series of additional cuts between now and 2026. In general, we see this move as favorable for the economy, for companies, and for stocks, though there may be some mixed impacts on the bond market, which we'll turn to in slide 8. So as we shift from the economy to financial markets, let's start out with bonds, which generally provide a low to mid-single-digit return for portfolios as a way to balance out stocks, which can be more volatile. This year, bonds are performing about in line or maybe a little bit better than usual. We thought we would try to break out where this performance is coming from. As the Fed has been signaling lower interest rates, we've seen a modest decline in yields for many bonds, including a basket of high-quality government and corporate bonds, such as the Bloomberg aggregate. As these yields come down, prices move in the opposite direction, and they're going up slightly, and that's helped performance. Additionally, we're still getting some nice coupon income from these bonds, and that helps to get us to a performance of around 4 or 5% in a total return so far this year. So with that, let's compare what we've seen in the bond market this year with stocks, which continue to reach new highs. Next slide, please. So in general, we are seeing good returns this year, both for stocks and bonds. We just walked through performance in the bond market. Now let's turn to stocks. Now you may have to squint a little at this chart. Apologies for the colors there. But if you see, in terms of the brown line there, stocks, this was as of the end of September, we're up about 22% year to date, which is typically kind of above what you would see for a given year for stocks. So what's driving that? I would argue the Fed's shift to lower interest rates, steady corporate earnings growth, and a general rise in investor sentiment are all helping stocks perform well and overcome some of the corrections we've seen this year, including a 10% move lower in August. Likely that was on fears of a worsening job market, concerns about semiconductor stocks, and also some volatility in the Japanese market, which spilled over into the US. So while equities are doing well overall, we are seeing some changes under the hood. And with that, we'll get into it in the next slide. Okay, so as we just mentioned, there have been some concerns about semiconductor stocks this past summer, and that's just part of a story we're seeing with tech and growth stocks in general, taking a bit of a breather after a big move up since late 2022. That's when ChatGPT kicked off a wave of investor excitement for artificial intelligence, or AI, hardware, including semiconductors, as well as cloud computing and software. However, starting in July, we've seen other parts of the market outside of tech, sectors such as industrials, financials, and especially utilities, trade higher as tech remains somewhat below that July peak. While interest rates and a steady economy may be helping some of these defensive and cyclical companies, let's take another look at why tech stocks might be moving to the slow lane for now. Next slide. So one reason tech stocks may be cooling off could be that the sector has become a victim of its own success. What does that mean? The chart here that we're looking at shows that sentiment for the tech sector, as measured by the price of a stock divided by the company's earnings, or PE, has gotten red hot in the last 5 years. This is the upper line. In part due to a couple of things. One, the demand for technology moved up a lot during COVID, and then we saw a second wave with AI kick in really in late 22. By comparison, if you look at an equally weighted basket of the top 500 stocks in the US, S&P 500, that's shown pretty stable sentiment really over the last 5 years. So our sense is the high tech sector valuations could be giving some investors pause, perhaps leading some to favor other sectors which have modest growth with much more reasonable valuations. So now that we've discussed investor sentiment for tech stocks and some of the other sectors, let's take another look at market volatility as a measure of investor sentiment. Next slide.
Mike, if we can hang on here for a second, I think
Sure.
it's useful just to pause for a moment. So a couple questions come to mind as we talk about this. So equal weighted versus tech stocks. Let's talk about if we drew, a green line in the middle here that is just the straight S&P 500, which is a market cap weighted index. That line would end up at 21 or 22 times earnings in between these two, correct?
That's right. That's correct.
Okay. And then maybe just for our listeners, our viewers, talk about the difference between the equal weighted and the cap weighted and the composition of the cap weighted vis-a-vis technology, right? So that 29 multiple or 30 multiple in terms of, the weighting there.
Yeah, absolutely. No, great question. So this slide, there's a lot of data here, and it's definitely worth unpacking. So one of the big trends we've seen really in the last 10 or 15 years, but it's gotten very significant in the last couple, has been significant concentration in the U.S. stock market. What does that mean? People talk about the Magnificent Seven, sort of these top mega cap tech companies. These companies are big, they're profitable, and they're growing very quickly, and the stock prices are chasing that. So if you were to line up the top 500 biggest stocks in the US, really that top 5 or top 10, they take up a big chunk of that entire index. So it's really, if you were to think about a bell curve, you've got a ton of stocks really kind of on that far right end, and that does make things a little bit imbalanced. So for example, if you go back the last couple of years, if things are really working in the tech sector, those top 5 or 10 big companies, Microsoft, Apple, Google, et cetera, those stocks are really working. That's a big chunk of the market. You go all the way down to stocks number, 450, 475, 500. Those are much smaller and just are really not moving the market. So I think the idea here with this chart is to really kind of break that apart and say, let's look at the big tech companies in general. Sentiment is really going gangbusters there. The flip side, you look at the other 500, treat them all equally. So a huge company like Apple is worth the same as a really small company. On that basis, the other kind of 500 equally weighted, sentiment's been pretty stable. And so I think that's the point there, that there's a lot of excitement built into tech. Everything else, it seems like it's priced fairly reasonably. And we are seeing investors come back to the everything else and starting to buy those.
Perfect. Thank you, Mike. That's helpful.
Great. Absolutely. So again, great kind of segue. If we can go to the next slide, slide 12, and kind of go from looking at what's happening in sectors to just looking at the broader market. And we are seeing some changes here. So I think one way to think about that is volatility. When you get sometimes a change in market leadership or just different parts of the market that are winning or losing, you get some unexpected choppiness in markets, and that's kind of what we've seen. So we mentioned earlier there was a 10% market correction in August. One of the factors that may have led to that, frankly, was some complacency. So this chart shows the VIX or fear index. It measures market volatility. You can see a big spike during COVID and another one in August. Again, that's kind of the same time when investors were a little bit nervous about tech stocks, and we saw that big change in what parts of the market are starting to do better. One takeaway for us is that when volatility is low, investors often become complacent, expecting smooth sailing. However, these sort of rose-colored glasses can often be a recipe for choppier markets, especially if investors get unexpected bad news, like we saw in August. Again, job market looking a little bit worse, semiconductors seeing some challenges, and then some currency issues in Japan, which all came together and led to that market correction. So to be fair, this approach to markets can be a little bit short-sighted. And with that in mind, let's turn to the next slide to review some longer-term themes that can have a much more significant impact. Next slide. So our high-level approach for compounding wealth has really been to focus on countries and regions with steady economic growth, such as the US, and focus on stocks that are tied to long-term earnings growth. On a short-term basis, we do continue to monitor geopolitical events. This can include anything from big elections, market corrections, such as what we saw in Japan this summer, or even the unfolding conflict in the Middle East. However, we remain committed to a long-term approach, which suggests staying fully invested in companies that are growing and improving over a number of years. With that, let's turn to our positioning on the next slide. So despite some of the market volatility, which we talked about, our positioning has been fairly consistent. We've had a focus on locking in attractive bond yields for upwards of 10 years. On the equity side, we've been maintaining a high exposure to the US, where we're seeing market share gains and higher margins drive faster earnings. We're keeping cash levels low, and that helps us avoid market timing, as we believe being fully invested in portfolios of bonds and stocks offer compelling long-term opportunities. Next slide, please. So as we wrap up, we see a continued expansion for the economy and earnings with broad-based growth across tech companies as well as others such as cyclical and defensive sectors. We prefer to remain fully invested across stocks and bonds, and we believe our holdings have the potential to meet or exceed investor expectations. With that, thanks for joining us for some prepared remarks. And now let's turn it over to your questions. Mike?
Very good, Mike. Thank you for that. So as a reminder for our participants, if you look at the bottom of the Zoom screen, there's a little box on the bar at the bottom of the screen that says Q&A. So feel free to type in some questions as you have them. And we'll get into some of the questions that were asked beforehand. The winner here, submitted by several, Mike, is Ralph and Bill and Sue, to name a few. Any thoughts on how markets, stock and bond markets, might react to a new administration headed either by Kamala Harris or Donald Trump? And I'll expand that in terms of maybe talk about economy and markets, stock and bond markets.
Absolutely. So maybe we can do, we anticipated some questions on this given the timing of the election coming up in basically a month. Ronan, if we can turn to slide 18 just as a reference. Certainly every election cycle and frankly every big geopolitical event, each one can be a little bit different. And so you do have to look at every single time, what are the nuances, what are the risks, what are the potential rewards. For this particular presidential election, as we sort of think about it, we would probably put this in sort of a typical geopolitical type of a risk factor. So if you look through history, whether it's an election or something's unexpected, many times you will get sort of a low to mid single digit change in markets. That could be a plus or minus a few percent. Oftentimes these things can be a bit downside, especially if the geopolitical event is a conflict or something like that. So that's sort of the order of magnitude where we would think about this election. If there's something surprising, I think the polls are pretty tight at this point, but we'll see what happens. So as we look ahead to both the economy and markets, as we think about different scenarios for which party could take power in the U.S., our sort of general approach is that we prefer to be fully invested as opposed to, you can see some of the data here. If you try to really time the market based on which party is in the White House or in control, you're really you're missing out on a lot of upside. It would be better just to stay in the markets. That's kind of sort of a job number one for us, is to be fully invested. However, we do want to go a little bit deeper and think about different changes that could happen based on who's in charge. A lot of times, unfortunately, it can be tough to anticipate exactly which part of the economy or part of the market could benefit or take a risk. There's certainly traditional with blue and red. There are sectors, parts of the market that may feel pressure, whether it's if there's a blue wave, perhaps banking or energy or healthcare may see some pressure. The flip side, if there's the GOP takes control, you can see the opposite. So those are some things we're looking at. In general, it's really hard to anticipate that. So we're continuing to be fully invested. And I think the other piece here is being diversified. So we're making sure we've got exposure to companies, across the board in case something does happen. The one sort of question mark for us in the sort of short to medium term, frankly, is fiscal policy and in particular taxes. If there was any significant change in the corporate tax rate, for example, that would impact companies, how much money they're earning, whether that rate goes up or down, we'll have to keep an eye on that. But in general, I think we have less of a concern for a massive shift in the economy and likely any massive shifts for most companies. However, as I mentioned, the tax rate is a critical issue. We'll be watching that.
So just mathematically, tax rates on corporations go up, the amount of net income or net profit that those same companies make, all else being equal year to year, goes down. They're already trading at a multiple or sentiment of PE multiple that's based on the higher net income. Thereby, those companies actually become more expensive to the
Right.
market because their profitability goes down, right?
Yep.
So that's kind of
Absolutely.
the way that the math works there.
Yep.
Um, okay, great. We'll come back to something else on the elections that I want to touch on. But we have a question from George, which was good. Jumping back to the slide on the sentiment or the PE ratios, which was I think Ronan's slide 10, 8 or 10. So we spent a minute, Mike, talking about market capitalization versus a cap weighted versus an equal weighted, and uh, George asked, fair question. Yep, that's at 11 there, Ronan. Thank you. Do you pursue an equal weighted strategy rather than market cap? And so I think that's a fair question. So let's maybe just talk about that for a minute.
Yeah, absolutely. It is a fair point. If you go back through history, until a couple of years ago, the equal weighted S&P 500 and the market weight, just the regular S&P, they were pretty similar. They really did not see huge kind of variances. One big winner, one big loser. We have seen this maybe surprising concentration of stocks at the top end. So things have really changed. Who knows if that's going to be a permanent change or temporary? Is definitely the right question to ask. I think, on one hand, you could say, well, if you buy low and sell high, maybe you want to go back to an equal weight because you're going to go back and own a lot of those smaller companies, which may be trading a bit cheaper. I think the question for us is, what is the reality we're in right now? What are pervasive market forces that we have to deal with as we're picking stocks? As we look at the upper end, the top 5, top 10 companies out there, they're big, they're growing, margins are improving, they're gaining share. And so those are companies that we do want to participate in. No, we don't blindly just say, hey, let's dive in. We're picky and choosy. And when some of these things get a little bit too expensive on an individual basis, we do trim here and there. But there are some attractive companies, and I think it's a good place to participate. However, we do certainly own companies across the spectrum, so, well below that top 10, certainly in the lower rungs. So it's a great question, something we're going to continue to work through, but I think it is worth going company by company and looking for businesses that are improving and owning those.
Great. Thanks, Mike. Another question submitted here, and I'll remind folks, go ahead and if you have a question on any topic, including outside of what we talked about in the prepared remarks, please go ahead and type that in at the bottom of the screen under the Q&A. Mike, I'll take this one. This is from my friend Mary asking about a good time to liquidate and or contribute stock to a charitable donor advised account. So generally speaking, you want to make donor advised fund contributions or charitable contributions in general when stock prices are up. Stock prices are within a whisker of all-time highs, so there's no time like the present. We also find ourselves here on October 3rd in the fourth quarter of the calendar year. And if you're trying to make a move for your charitable endeavors, there's again no time like the present because that has to happen before December 31st to get credit for calendar year 2024 for taxes. So when it comes to donor advised funds, not all clients have them, but if you do have a donor advised fund, remember the best mechanism there is to actually appreciate or donate the appreciated stock rather than liquidating it yourself, because you kind of get a two-for there. You don't have to realize the capital gains, and the donor advised fund itself liquidates the appreciated stock, and then you can make grants to charities, World Central Kitchen, Red Cross, your alma mater, whatever, directly from the donor advised fund, and you don't pay taxes in the process. So if you have more questions there, please reach out to your portfolio manager, and she or he would be happy to help facilitate. One other thing on timing, it is the end of the year. So again, by just things that dates we cannot move are primarily are December 31st when it comes to taxes. So the other item to think about is required minimum distributions and Roth conversions. Our monthly e-newsletter that comes out in the middle of every month. I think the next one, which will be out in 2 weeks, will talk about reminders of things that we want to do before the end of the year. And my advice there is always do not wait till December to start on that, right? Like get that going up uh, through get that going through November rather than waiting till the last minute in order to get processed. Um, Fair question here. Cynthia says, we heard about the stock appreciation this year. Didn't hear what performance of bonds has been, although we did make a statement about locking in rates. So you want to talk about the fixed income market? I think we talked about it in terms of breaking down the components of performance, and maybe Mike, while you're talking about that, maybe Ronan, you can throw that chart back up, and let's spend a minute there, please.
Absolutely. Yeah, I think it's slide 8, Ronan, if you're able to pull that one. We can sort of talk through this and then maybe the one following it. So yeah, so far I would say it's been a pretty reasonable year in terms of a bond market performance. If you look through history, at a basket of quality bonds, treasuries, high quality corporate bonds, that sort of thing. So no junk bonds, stuff like that. Historically, the return's been about 3 to 4% per year. Not that exciting, but that's the whole point. You don't want this part of your portfolio to be exciting. You want it to be there. You want it to generate returns around inflation, hopefully a little bit better. Again, this is your insurance policy for equities. Equities, that's what really appreciates, but you just don't want to be 100% equities for most folks. The bonds really are going to offset that. So, but you do want to have some kind of bond return. Again, just to lay out the math this year, so you've got this inverse relationship as bond yields go down, prices go up. So we've seen a little bit of movement there, a couple percent. And then the flip side is coupons. Bonds just they pay these coupons per year, 2.5. So add that up. At this point in the year isn't done yet. We're around 4 or 5%. So if we were to just sort of end the game right now, it would actually be a slightly above trend, kind of above that 3 to 4% range, which is pretty good. But we'll see. These things definitely move around. Maybe if we can run and turn to the next slide. This was the stocks and bonds up here today. Again, apologies, a little tricky to read here. A lot of dark stuff on the screen. The bottom white line is the bond market. You can see it hasn't been smooth sailing even for bonds. You can see things trail down towards the beginning part of the year, and they've started to creep back up. So again, part of that is what's going on with interest rates. The other part is some of the coupons we've seen. So again, pretty good year so far. Hard to know what'll happen in the last quarter of the year. If there are any wild swings in the economy, if you see inflation roar back, if you see something unusual with the job market, that could certainly impact what bonds are doing. At this point, that seems a little less likely, but we're going to have to keep an eye on it.
Great. Thanks, Mike. Got a few more here. And again, feel free to type in questions if you got them. We have somebody who asked, what happens tomorrow, Mike, if there's a poor jobs report, and then a little bit more broadly, of what the effect of AI may be in terms of permanent job elimination.
Yeah, some good kind of a short-term question and a very
Yeah,
long-term
very
one.
short term, and
So
then a futurist
got the
type of view there. So we'll take it.
got the barbell approach to
That's
it.
right.
So what happens tomorrow? Every month you get a jobs number. There's a lot of excitement. You turn on cable business news and they're all in a tizzy about it. And it seems like that happens every month. What about this month? So hard to say. We get a little bit of an interim look. We get weekly data that comes out. Weekly data has been pretty good. So I wouldn't expect a huge, a great number or a terrible number tomorrow. The question was, what if it's a really bad jobs number? I think in general, stock market might take a little bit of a breather. When markets are up, which they generally have been, that's sort of expecting things to go right, sort of macro data, the economy, as well as companies. So you could see a little bit of volatility. I think if you take that out a little bit further, the Fed has already taken action to address or prevent a spike in unemployment. So the Fed cut interest rates 50 basis points. Usually it does it 25 basis points, so an unusually large rate cut to get ahead of a huge move up in unemployment. So even if the job market is a little bit mixed tomorrow, a little worse, my sense is investors are already anticipating that the Fed has kind of got your back. So the Fed, if there's a bad jobs number, the Fed might come in and cut more aggressively as sort of a plan B. I'm going to the other end of the extreme in terms of AI and what that means towards jobs and the job market. It's a very good question. I think at this point, no one really knows. I think no one has a great crystal ball. You could see a couple scenarios. You could see a lot of, frankly, white collar jobs start to shrink or demand for those jobs shrink if AI starts to work. The flip side is, and I think historically what you've seen when you get a brand new wave of technology or a new tool, that really helps people just do more or even do more with less. So you could see an increase in productivity. So instead of somebody producing 10 widgets, a day, they can produce 11 or 12 and really eliminate some of the boring work. So it is a little bit hard to say, and I think this is definitely unfolding. History would suggest probably not game over for workers, but we're going to have to be kind of evaluating this thing step by step, and it will probably be a big theme for our investment research here for the next years, and we'll certainly be back in touch with you guys on these quarterly calls.
Great, thanks. Wayne asks a question here regarding the tenuous situation around Taiwan. How is U.S. chip development faring and expectations um, over the next few years there?
Yeah, absolutely. So again, goes a little bit goes to geopolitics, but this question is very specific for a particular sector and even a few companies. So there's been sort of this shift, and in particular the U.S. in terms of policy, trying to encourage more domestic semiconductor manufacturing. We're starting to see that a little bit. We've seen big companies, Taiwan Semi is building in Arizona, Intel is building domestically some more stuff. So we are seeing that start to happen. That is a multi-year process. It takes a long time to get really up and running. However, I think the reality is a majority of the sort of really high-tech cutting edge chips, they're made by Taiwan Semi, they're made in Taiwan. If there is an invasion, a lot of smart strategists have talked about this. That would be very difficult for Taiwan Semi, but I think the issue is China knows this, and they know that if they invade and shut it down, that's really bad for China. So it's a little bit of a feedback loop there. But in general, we're seeing a little bit more diversification of semi manufacturing, but it's going to be a number of years before that becomes a more significant theme.
It's worth noting, even Taiwan Semi is creating plants here in the U.S. at this point, Mike. So it's they're diversifying as well, some of that risk, or at least trying to. Okay, Doug asked, the overall federal debt is getting more attention recently. What impacts do you see on the markets as the debt continues to grow? I'll take a stab at this one, as it's something that's kind of near and dear to my heart, and then Mike, feel free to jump in. Yeah, Doug, it seems like we always get a little bit more attention to the both the deficit and the ballooning debt around elections, and we have one, here in 30 days or so. So it's getting a little bit more attention. It should be getting attention. The fact that the debt has increased to the degree that it has in the last, 15 years, the last, 3 administrations, is alarming in terms of the percentage rate of growth, compared to where we are in terms of GDP and these types of things. And since COVID, in strong economic years, to have deficits that are adding to that debt, right? They're adding to that credit card every year is at least over 200 plus years of history is abnormal. But here we are. And we happen to have 2 candidates that are running for the executive office of the land who seem to be very comfortable with adding more debt. We're talking about the size of it, but there's been no real discussion of deficit reduction on either side. So we've actually witnessed, with higher interest rates, a little bit of comeuppance here in the last 2 years as rates to borrow have gone up at any given time. The U.S. has, from a fifth to a third of the debt rolling in relatively short-term securities inside 12, 18, 24 months. And as they've had to refinance that debt, and FBB and our clients have been buying some of this over the course of the last couple of years, 3-month, 6-month T-bills at 5.3, 5.4%. Now those rates have started to come down as interest rates have come down, but the interest expense part of the P&L, if you will, of the government, the U.S. government, the interest expense component has ballooned along with interest rates. It would be the equivalent of everybody on this call having a pretty healthy mortgage, even though they have healthy incomes and good stable jobs, a healthy mortgage, that started at 2.5% or 2% 3 years ago, and ballooned, to 5.5% in terms of cost of borrowing. Your interest expense would have doubled in that instance. So long term, it is a concern. Near term, market participants don't really seem to care. The U.S. is still the best house in a somewhat questionable neighborhood when it comes to developed economies and their equity and their debt markets. As long as there are people to buy that debt, 33, $34 trillion of it, then there are no issues. So the growth story of the U.S. economy, the growth story of technology in the U.S. and its contribution to society around the globe, that story is still intact, as is the story of the U.S. dollar in terms of a reserve currency. We take those two things for granted at our own peril. Personal opinion there. But I do think this isn't a super near-term issue. But when you look at the scale and the growth of these numbers, long term, and I would say long term is, not 30 years, it's, the next 10 plus, something has to give, and it'll be interesting to see if we actually have some leadership to address it at some point. So, Mike, anything to add?
Yeah, the only thing I might add is, people have been asking me this for years and years now, and it's hard to know when is this going to pop, kind of thing. I think one of the concerns I have, or just maybe just a realistic expectation, is that we may just get a recession. I mean, you get recessions every few years, and this could be a U.S. debt type of recession, and that's perhaps a signal for politicians out there that we actually need to take it more seriously. So there's a business cycle; these things come and go, and perhaps that could be part of one of them. But we'll see. But again, in the short to medium term, I'd say the next 2 to 3, maybe even 5 years, I think it's less likely to weigh down the economy or impact companies and earnings.
Great, thank you. All right, so we have two final questions here. One is a near-term question, and one's a long-term. Longer term. We'll start with the near-term first. Francis asks, will a long-term longshoreman strike affect specifically any stocks? But let's expand that to include the economy.
Yeah, great question. So we've gotten these kind of supply chain, problems from time to time. There was certainly a big one coming out of COVID, where there was a lot of demand, and then just the supply was tight, and so that was a big problem. And that, frankly, was one of the reasons we got this high inflation in calendar 22. The current East Coast and Gulf port strike, is that going to be as bad? Probably not, because it is a little bit, it's regional, it's not global. But it is significant. I mean, it impacts a big chunk of the U.S. economy. Everything that I've seen and read suggests that if this thing goes for a week or two, maybe a little bit longer, probably less likely to have a big impact. If it goes longer than that, yeah, you are going to see some significant issues. In terms of what sectors or companies to be thinking about, certainly retailers and folks that are doing a lot of importing. That is one issue. I mentioned we did a channel check with this company that does, they rent a lot of consumer products, doormats, and bathroom cleaning supplies, et cetera. They do a lot of importing. This particular company, they tend to dual source. They import out of the East Coast of the U.S. as well as the West Coast. So I think bigger companies likely have kind of been through this rodeo once before, a couple of years ago, and so they're anticipating, sort of looking at their supply chains, anticipating problems. So we could see some isolated issues with a few companies, but again, if they can work this out in 2 or 3 weeks, I think we're going to be in better shape.
Great, thanks, Mike. Last question comes from George. George, I'm going to take some liberties here and expand the question. The question is, will stocks continue to increase, by around 10%? I'm gonna put a time frame on that, Mike, and say, or I'd rather ask the question: what are profit estimates today looking like for 2025? And if in terms of growth, and if stocks follow earnings with growth rates and dividend yield, what might we look at when we're sitting here, a year from now or 15 months from now through 2025?
Yeah, great question. So, it's been a good year for the end of the year right now. Kind of 20% plus returns is pretty good. But the question is, let's look ahead. What can we anticipate? Historically, you've seen the stock market go up around 10% a year, kind of 8, 9, 10, 11%, something like that. However, if you look at any individual year in particular, it rarely kind of fits that mold, that cookie cutter mold. So this year was above trend. If you go back to calendar 22, it was a terrible year. So the question is, what are we seeing ahead now? And to get to your question, companies are projecting profits, how fast it is going to grow. At this point, it is around 10% for calendar 25. So if that were to completely come true, you could see an opportunity where stocks continue to follow that and go up 10%. I think the question, though, is sentiment. So sentiment right now, we showed some of these charts, the price to earnings ratios or PE. That's an indicator as they've crept up that investors have very high expectations. So I think if you do see any unexpected disappointments out there for a lot of these big companies, yeah, I would expect something less than probably 10%. So it's hard to say. And I think as one of our slides talks about taking the long view. We look at companies, we go quarter by quarter, we want to understand what they're doing, but we also want to think about how these businesses are compounding wealth over a number of years. So we'll see what happens in calendar 25. Could be an average year, could be better or worse than that. But really, I think that the point is to focus on businesses that are able to improve, grow their earnings. Stocks generally going to chase that over a number of years, and that's kind of the main focus for us.
Thanks, Mike. One of the wonders of working from home, we've got a dog barking in the background, so my apologies. All right, right on time. That's all the questions we have today. Again, thank you for tuning in. Should you have any questions on anything we talked about today, please reach out to your portfolio manager. And also, as we talked about, as we're in the fourth quarter, if you have any planning questions or anything when you get the e-newsletter here in a couple of weeks about fourth quarter planning and some items that need to be done between now and the end of the year, don't hesitate. Please reach out. Mike and I look forward to shooting the next one of these back in the office. Same location, just a little bit refreshed space, and hope to visit with you all there in the not too distant future. Thanks for coming and joining us today. Thanks for your time, and have a great afternoon. Goodbye.
Thank you.